What's up, guys? Welcome back to Everyday Money. What I want to do today is throw a hypothetical at you that I think would be interesting, especially when you consider what was going on at these different times. What if you could go back in time and you could take and invest either all of your money, or you could purchase a home, or you could invest in real estate at the peak of any given market right before it crashed. Fast forward to today and be able to realize the gains that were made between that peak before the crash and where you are today, without having to actually live through it, without having to live through the panic, the nonstop media cycles, especially in the last major crash, and just straight up realize those gains. So put all your money in right before the 1929 crash, put all of your money in the Friday before Black Monday, before the dot-com bubble, Great Recession. If you could just buy the entire market, like an S&P 500 fund or a total market fund, think about doing that and go ahead and hit the like button, and we're going to talk about why that is relative today and what you can do when it looks like things are at the peak of any given market. So I got this idea because a lot of times when I'm reading stuff on the internet, a lot of times on Facebook, it'll be like a CNBC article or something, and there'll be just thousands and thousands of comments, and they'll mostly all be, we're in a bubble, I'm going to wait for the crash, I'm going to wait for the crash to invest in stocks, I'm going to wait for the crash to purchase a home, I'm going to wait for a crash to invest in real estate. And those are great times to get into any type of investment. Anytime things are in the red, for the most part, as long as it's not a company that's actively going out of business, is a good time to buy those stocks. But these folks that are waiting around for a crash are probably going to end up losing quite a bit of money in the long term. Because although corrections and pullbacks are relatively frequent, the things that happen in any given market, major crashes aren't as frequent as, just your typical run-of-the-mill 5, 10, or even 15% pullback. Now, what I think is a lot of folks got burned, and they got very impressed by the latest pullback that we had, the latest crash that we had in 2007 concerning housing and the stock market, when we had just that meltdown that was formative for a lot of folks. A lot of folks that watch this channel, according to my analytics, are between 20 and their late 50s, and I think that mentally psyched a lot of people out, especially people in my generation, the millennial generation. That has really psyched out a lot of people to invest in really anything, because they've seen this crash. They saw people lose their homes. They saw people lose their jobs, lose their savings, and there was just a lot of media around it, which was probably one of the first major crashes that had the 24-hour news cycle associated with it. Right now in 2021, we are at peaks in everything. We are at peaks in the stock market. We are at peaks in the housing market, and so this is an argument that people can say is that we're at a peak. There has to be a crash following this, and they're going to wait until that happens. So what I want to look at today is mostly the Great Recession with the stock market and the housing market, and what the results would have been if you would have purchased or put all of your money into the very peak of it and were able to ride it out. If you lose your home or you lose your job, that's a totally different thing. But if you were able to ride it out and you either bought a house at the top of the market or you bought stocks, where you would be today in 2021 if you could ride it out. Because these people that are calling crashes, even the professionals, even Michael Burry and the folks like them, and if you're not familiar with Michael Burry, go watch the movie The Big Short. He famously shorted the housing market, and so he's been kind of the bear Nostradamus of our time since that happened. But the thing is he has called crashes for like year after year after that. 2011, 2015, any given year, you can see someone calling a crash in the markets, be it the housing, the stock market. All right, so first off, we're going to take a look at the housing market. What we're looking at here is the median sale price of homes in the United States per for the U.S. Fed, from the St. Louis Fed. If we look here in 2007, the market peaked for housing at $257,400 for your average single-family home sold, and then it went down, it crashed to $208,400. Now, what that is basically is a 20% decline in the price of housing, which is, I think, a lot less than a lot of people think. A lot of folks think it went, precipitously down, and in some areas it did, in some areas it did not. But the average was about 20%. and that was a loss of about $49,000 in your average home price sale. And this is where a lot of folks who are going to either want to buy a home, which is a lot of folks in my generation, the millennial generation, especially the younger folks in that generation, they state that they're going to wait for the next crash. And really, if you're looking at how much this crashed, 20% doesn't equate to a lot of savings in the average home price. And then, so if we go up here to where we are today, the average home price is $374,900. And if you would have purchased a home at the peak of the market in the first quarter 2007, and you held that home until today, you would have realized a gain of $117,500, which is about a 46% increase in the price of that home in the whatever time frame of how many years that was. So if you would have purchased a home at the peak of this market, held it until where we are today, which is a market peak, and then there's no way to say that this is a market peak that's going to crash or a market peak that's just going to continue to peak and peak and peak as time goes by, which, by the way, markets in the United States go up, especially housing and stocks. They have historically gone up over time. And if you look at this entire housing market, median home price sales, you can see that this isn't even really an exponential curve. It is more of a linear curve, or a linear path from the start of this in 1963 all the way up here to 2021. So that just illustrates that even if you were to purchase real estate at the very peak of the market, hang on to it for a decade or so, you would most likely realize a gain almost no matter what would happen in any type of market downturn, recession, crash, whatever. So now that we've looked at that, let's look at what would happen to the stock market during that time, and if we see very similar things and what would have happened if you would have just smashed all of your money in addition to the like button into the stock market at the peak of 2007 to where you would be today. All right, now when we look at the stock market from the same time period, and again, I like to just use this one because it's the freshest one in people's minds. If you look at the peak at September 28th, 2007, that's as close as I can get it on this Google stock market chart. And if we run this out, and you can look and see that it goes down to somewhere here in early 2009, we peaked, or the opposite of peak, we troughed at about 50% decline in the stock market from the previous peak. And there was a lot of, obviously, news about that, and people were freaking out. A lot of people lost a lot of money, at least on paper, until they sold it and then maybe locked in those losses. Then they actually realized a loss. But if you would have put all of your money in at the top of that peak, and you would have held it until today in 2021, we're on September 27, 2021, you would have realized an almost 200% gain from peak to peak on this. And this is just the peak so far. Now, so it could crash tomorrow, or it could continue to go up at 10 or 12% for the next 20 years or so. Obviously, there's going to be some pullbacks and such over time. For example, right here, coronavirus, we were up 118% from the other peak in 2007. And when that went down, I believe that was about a 30% decline or so. But you would have still been up 57% from your 2007 peak. There was also this December pullback right here in December of 2018, and that, again, still would have been up from the 2007 peak, still would have been up from the 2018 little correction there. You still would have been up tremendously from the coronavirus crash, and that is just going from the latest peak of the market in 2007. Now, obviously, it would have been better if you could have called the bottom down here somewhere in 2009 and rode that all the way up. You would be looking at a almost 500% increase in the value of your holdings. This really gets into the ability to call peaks in valleys, because even the multimillionaires on Wall Street who are thinking about stocks in their next trade in their hedge fund probably 24 hours a day, they're probably even dreaming about it while they are not technically at work, they cannot accurately call tops and bottoms. They get on CNBC, they get on the internet, they do it all the time. They're like, I think we're at a peak, I think we're going to have a crash, and as you can see here, the market just continues to go up over time. So if you have a long-term outlook on either stocks or housing, or along with housing, rental properties, as far as their valuation is concerned just from a not from the rent portion of it, but from just the market value of the properties. If you have a long-term outlook on that, it really doesn't matter right now if you purchase at the peak or not. If you are sitting there and you're waiting for the next crash, the thing that you need to think about is, what if the market just continues to go up and you don't find that crash time? Or if the crash is only 10%, but it wasn't good enough for you because it didn't come down to 2007 levels, and then you miss buying in at that little dip, and then you continue to just watch the market go up and up over time, which it historically does since the records of the market have been being kept. If you go back and invest in the market right before the 1929 crash, you would be probably a gazillionaire. I haven't done the math on it, but you could probably put in a very small amount of money and have a ton of money right now. My point is that if you do have a long-term outlook on this, and you can watch the value of your holdings go down, knowing that they will most likely go up as long as you're investing in property or stocks in the United States. And I do have a very bullish outlook on the United States, not simply because I'm from the United States and I'm a flag waving American, just because I think with our population diversity, with our 350 million people, with our manufacturing base, with our levels of education that you can achieve in this country, with just the level of entrepreneurship in this country, and with the amount of financing and support that's available, I always believe that the United States will always be bullish no matter what is going on in the world, no matter what the political climate is. As far as business and money is concerned, I will always find the United States to be a very bullish country to make money in. Guys, if you like this video, be sure to give it a big thumbs up. That really does help me out in the YouTube algorithm. If you haven't subscribed yet, be sure to hit that subscribe button down below to grow your wealth, increase your success, put you on the road to financial freedom. We talk about all things real estate, stock, money, creating streams of passive income so that you can get some freedom in your life. I appreciate you guys watching today, and I'll see you in the next one.